All right, we bounced today, and we were led by some pretty decent leadership. So I'm going to break down today's rally and see what that does, or what that does to any existing red flags that we've had, or if it pulls up any new red flags in terms of this bullish posture that we have been on, that we're starting, and seeing whether or not that it's actually going to take hold, or are we going to reverse. So I'm going to break down some of the technical signs that show us that trend that we're on, but also the red flags that we need to be watching out for here for the next couple of days, as well as what my expectations are based on what I'm seeing on the chart. So I'm also going to talk about one stock that was in the news that's in one of these leading areas that broke out, and we're going to talk about how to trade it without chasing it. So let's go ahead and get started. Today is Wednesday, September the 25th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as always, let's start off taking a look at the market forecast on the S&P 500. You can see the nice little bounce back up that we had today brought the near-term and the momentum line back up, but did not get the near-term line back above 50. So now this is a pretty decent pullback here. 1, 2, 3, 4 days now with the near-term line below 50. The typical time frame, if you're bullish on a bullish trend, is 1 to 3 days. Now, granted, we're on a bullish trend, but we're just on the very, very beginnings of a bullish trend. And so it's still weak. In fact, if you look at it at the Ichimoku cloud here, you can see here's the S&P on a daily trend. We're still below weak levels. So it's above their midpoints. We still have a bullish posture, but it's weak. It's just barely started. It's weak. You can see, we've similar, you get started and it doesn't get going right off the bat. You get started over here and we have a little bit of a pullback. And again, I've compared this period before to that initial pullback there and then this pullback right here where we just kind of stall. Well, that's what we have. We broke through into the upper half of the charts. So we have a trend, and it's a bullish trend according to this chart, but it's still weak and we're getting going. So it's not surprising to see, like in this case, a bullish near-term run that didn't last, that wasn't typically bullish, right? It didn't get up above 80, didn't stay above 57 to 12 days, and then a bearish near-term run that didn't, that's now down, it didn't quite get below 20 yet, but it's been down below 54 days. So 1 to 3 is a typical, similar to something like this, and so we're not. It's not the most bullish, but we did pull down to this 2950 level, even if on an intraday basis, before bouncing here, 30 points off of that low point here today. Well, the low at 2952, so we came 2 points off 2950. But the idea was that we'd come down to this dotted line. We'd come down to what was here. Let's look at the 3-month chart. Here's this dotted line, which is the 23% retracement of the intermediate run that stalled right here in late July. And then this is the 38% retracement where my cursor is of this near-term run that we just had, that started this current intermediate rally. So and I even mentioned too before that if we did come down to 2950, it would be uncomfortable. And that's how it has been. These 3 days right here, a lot of people, the bears come out of the woodworks and think, okay, well, here we go. Where in reality, we're getting a little bit, if I zoom back out here, again, nothing's ever picture perfect in technical analysis, but you're getting, a little bit of a cup and a little handle pattern here. We'll see if it ends up turning into a breakout. We would expect it to, because again, the intermediate posture being, the typical run being 1 to 3 months. We did start this run in early September, so we're almost a month into it, even though we're still kind of in the early stages. Market sentiment's still falling. So that kind of shows you again how early this run is. You can see it took a while before market sentiment to take off here, and this was a shorter intermediate rally. Over here, both the intermediate and the market sentiment, lines turned up together at that point. So that was a little bit but it was much lower, so we had more of a bullish run as a result of that. So we'll see. Again, the expectation is now the near-term line will get above 50 and eventually above 80 and have a 7 to 12 day run, considering the posture. We pull back down with support. Support held. You always expect support to hold until it doesn't. Support has held so far. and then we expect another move, eventually up above 3,000 and beyond. Beyond at that point. How much beyond? We're not going to get this kind of bullish move. We're not going to get that kind of bullish move. The VIX is much lower than it is. In fact, if you look at the VIX here compared to where we were at the end of May, coming off of that low point, here we go. So even in May, daily chart. In May, coming off that low point, we were at 20s, and we were at 20s coming off of here. This low point we're coming now is just off of, it's just at 17. So even this double dip, right here by the beginning of June, we were close to 20. So, volatility, we had the 1 day. For those of you who are in my options inventory trading class, we took advantage of that day yesterday. That was our 1 day volatility spike. It got us up above 15 towards 17, and now again you can see after you get your one spikes, you tend to see volatility drop, and that's the expectation now as we drop back into, after yesterday's move, into the neutral zone, back into. We'll take a little bit more look at that here in just a second. Going back to the market forecast chart again, those are the expectations. You still have dark green shading and a green line, so as bearish as we were past few days, it still hasn't changed the trend. And always keep that in mind about short-term moves. Any kind of short-term move, has it changed the trend? And I mean, we can have a lot of noise, but unless that noise changes the trend, it's just that. It's just noise. You look at the Russell 2000, very similar. We got light pink shading here, but that's it. I mean, we just had a bigger drop yesterday, and now just like that, we're popping right back up off of this bullish, off of this low point, off this short-term low point. Again, the near-term line has not jumped above 50 yet, so probably going to have to break above the highs, especially the high of yesterday, that big large candle there. More than likely going to have to break above that high before you get a really good bullish confirmation that this intermediate line is going to turn back up again. And we did mention on the S&P that was probably our worst case scenario in any pullback, was we get light pink shading, and we didn't get that on the S&P. But had we come down more towards like 29 and a quarter, 29.25, and filled in all of this gap here, as I mentioned there on Twitter, then you probably would have had 3 red arrows and probably would have had light pink shading. But then that would have been it. It just would have been light pink shading with a yellow line, and that similar to this, and that would have been a great buying opportunity. So we didn't get that. Nothing's ever perfect. We didn't get that cluster over here. Nothing's perfect. But we're so close to those types of patterns as we saw here on the Russell. We didn't quite get the yellow line, but we got the light pink shading, and that can turn into a decent, like in this case over here, a decent buying opportunity to start the trend again, if that ends up being the case. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, there's a subscribe button down below the video if you're watching this on YouTube. That will notify you when you subscribe to our channel. That will notify you when these videos are posted. Also, hit the thumbs up icon that's down below this video. That tells me 2 things. Number 1, you like the video. Number 2, you want us to do it again tomorrow. So if that's the case, click that thumbs up. If that's not the case, then you don't have to click anything. We check the thumbs up according to the views to try to get an idea, of what the demand is for you all, for us to keep doing these videos. And then finally, while you're down there, comment. People come to our videos for the first time all the time. Comment on what you got out of it. Let the newbies know why they should watch and what they'll get out of it. Subscribe to our website, themarketscholars.com. There's a link popping out up there in the top right corner of your screen. That will subscribe you to our site for free. Join our more than 1,600 people that have subscribed to our website. Follow me on Twitter for more content in between these videos from day to day, as well as join our Market Outlook community that we've created on Facebook. All right, if you're watching our video on your blog, there's an easy way to subscribe to our site up there too. You can see right at the very top, there's a blue button. Click to subscribe. That will subscribe you to our site. Again, that gets you content in our blog from the market commentary. For example, the post I posted out today on sector correlations. Any post in there you get access to with your free subscription. Of course, there's other things too. There's our monthly plus plan that gets you access to our daily Market Outlook live videos. And whenever I do the Market Outlooks, I also go back and look at previous trade ideas, and we continue to manage those trades, something you don't get too often on when you're watching like other trading room or other education sites, because that's where the education lies in, right? Managing the trades you've done going forward. Finally, we also invite you to engage with us on social media. That will ensure that Twitter and Facebook post our content at the top of your timelines, especially if you don't look at it every day. And the way that you do that is just click here. Again, just hit this heart, open this new window. You can click on the like button, click on this image. It takes you to your Facebook account. You can like the Market Outlook post there as well. Again, the more you engage, really simple, the more that they think you like our content and you want to see all of our content, and they'll push you our content. Even if you've been away for a while, when you come back, they'll push our content right to the top of your timeline so you check it out. So we try to make it as simple as possible for you to engage with us. All right, let's go back to the charts here, and you can see, it's actually over here to the long-term chart. You can see that we still maintain some bullish momentum, though again, we're only middle of the week, mind you, but as of right now, we're getting a little bit of a transition candle, and that would be considered bearish, right? You look for it to cause a reversal. Now, there's been transition candles that have been kind of in the middle of bullish ones too. You can see those over there. You can see one right here. So I mean, you can see a couple over here. So that wouldn't be out of the realm of possibility at all. There's one right there as well. That's not necessarily out of the realm of possibility, but it's also not the best thing to look at. I mean, you would expect a reversal instead. So we'll keep our eyes on this as we head into the end of the week. Again, if we were to close up higher, then that will bring up the close, right? The high, as long as the high and the low start moving up, that will bring this candle up higher too. And if we get up to a higher high, which would be 30.21, then we'll get a higher upper shadow as well, and that would be bullish. So those are kind of things to watch for by the end of the week here. If you take a look, you can see the Dow is getting a transition candle, still above the 50-day moving average, mind you. The NASDAQ also with the transition, and the Russell with a really significant transition candle. So they're all, this is all something to keep in mind, that could change the posture that we currently have. It's a red flag, definitely, to keep an eye on. All right, let's take a look at the 3 green arrow chart, and you can see that we do have 2 red arrows, and that's typical when you get a pullback. You get a little bit of a dip here below the MACD. In this case, we also got the stochastics to give us a red arrow as well, but we are still above a rising moving average. We're still holding that Fibonacci fan for support, and to bounce back up to 304, 304.66. That area would get us back up and riding along that 50% Fibonacci fan again. Which would get back onto that bullish trend. From a 2-line perspective, right here, you can see that we are just like that, back up above the 17-day moving average and flirting with the 8-day moving average again. So again, the MACD histogram has come down, but it's, there's been times where we come down before a little bit below, without the actual MACD itself falling below 0, or even the average itself. In this case, you can see the average, with the MACD histogram got really positive in both these cases, and even the blue line crossed up above, but the orange line didn't. And we reversed back down to the histogram rolled over, and we reversed back down to the downside. So we'll keep an eye on this histogram and see, as of right now, it's still dropping. If it rolls back up tomorrow and gives us a darker red histogram, that signals that we're regaining some positive momentum again. All right, let's take a look now at the intraday move here, and you can see that rally we had all day long today. Very, very bullish rally, and it got us up to the point of control. So we've got a little bit of a kind of a sticking point here, an inflection point. We'll either kind of hold this, and we'll not be able to get through and get bullish again, or we break through that point of control, and it's now moving back up to the upside. So there still is some danger of pulling back here and moving down, and that histogram turning down. And again, that transition, right? If we finish Friday closer to the lows, closer to this, filling in the rest of this gap down to this midpoint of the 4-week range, if not below it, then good chance that turns this bullish posture around. We'll be back to being bearish again. But we break through the point of control, which is the the biggest level of volume here, and you can see where all the volume exists, then now we can make a move back up towards 302 and look for a new near-term run to really grab hold and see how long that one takes. Again, the average is 7 to 12 days, so we'll see if that ends up being the case. Let's go back and check the volume on today's range. Was just over average at 3.78 points. The volume is just over average too, about 73 million shares down there. So when you look at those two numbers here in context, then you can see that that's just barely above the average of the range, and the volume just barely above the average too, but not too high, right? When you get pullbacks, you're going to get bigger moves, right? And we are flirting with the 1% ATR. So if we were to break through and bounce back down below 3 points, getting ranges below 2.97 points, which is 1%, then that's going to be bullish, right? That's going to kind of lead us to the upside. Bigger moves of like 4 or 5 points, 4.5, 5 points, with volume 100 million plus. Those are bearish days, right? If we continue to get more and more of those types of days, then we can expect this bullish posture to turn back around and for us to get bearish again. Let's take a look at that. Retake a look at that VIX again one more time. And so we did drop back below the 90% mark. We are coming down. Again, we took advantage of that in my options inventory trading class, even at the beginning of the day today, yesterday and the beginning of the day today. And volatility dropped the rest of the day as we expected. And now the question is volatility going to form a higher low point here, or is it going to continue back below 15, which is kind of a key level, being as we are already below the 90% mark, and usually those two breaks occur simultaneously. So the relative ATR would suggest we're a lot more bullish than the actual ATR does so far. So that's a little bit of a red flag there. We'll keep our eye on and see if that leads us to being if we end up forming a higher low point here and reversing our way back up to what could be a new higher high. All right, so to summarize our technical outlook before we look at what's driving the price action today, different intermarket relationships, as well as our trade idea of the day, our posture is bullish. We're on a bullish trend. It's weak. It's just barely starting. We flattened out a little bit. There are a few red flags that could signal a reversal, a change in posture here, and getting back to the bearish side. So a few red flags that aren't trend changing yet, but definitely something to keep an eye on the next day or two. Again, the expectation is that we'll just start a new near-term rally here by the end of this week and into next week, and continue this intermediate run through for again the expected time frame, 1 to 3 months, and we're not even to the 1 month mark yet. And considering the seasonality, by the end of the year we could be bullish all the way through the end of the year for multiple seasonal trends that we have going on, considering how bullish the year has been so far. So what do you think? Do you agree with that? Do you disagree with that assessment? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll and vote. Either agree or disagree. If you click disagree, which is perfectly fine, then what I invite you to do is go down to the bottom in the comment section and share what you're seeing. Everybody's got their opinions, of course, but share what drives that opinion. What evidences are you seeing on the charts? Whatever indicator, whatever chart you're looking at, that would suggest either that you're already more bearish than we are, or that we could probably disregard those red flags and just hop on the bullish bandwagon. So share those down below in the comment section. All right, now let's take a look at what's driving price action here. And again, you can see the biggest winners today, in addition to the dollar we'll take a look at here in a second, was small caps. I mean, this is a pretty broad rally. Your small and mid cap stocks led the way higher. The diamonds, which is your smallest average out of all of these, was the smallest winner. You can see growth and value kind of matching each other. Dividend stocks doing well, all outpacing, all up a little bit. International stocks were the losers with the strong dollar, and they were both down. But you can also see too the sectors that were the best performers over the past 3 months. So it's 3 months, right? Yeah, the past 3 months. they're still the best performers, even with this bounce. So they were the biggest winners. They dropped the most during this pullback. They bounced the most after the drop. And now, you can see a really big, significant downward move to the downside. If you take a look at, if you look at the 12 grid here, let's pull that up. Here is right here. The different asset classes and how they're performing. Again, there's all your equity asset classes. You have strong bullish postures in developed markets, in preferred stocks, in real estate, high yield, foreign bonds, and the U.S. dollar. Look at that dollar move we'll talk about. But you can also see, too, a weak bullish posture, a weak bearish posture, in crude oil, as well as the yields. Again, for the markets are bullish, they tend to come up, too. And you can also see, again, still the weak bearish posture we have in the S&P 500 and the SPY. Now SPX doesn't have that, right? SPX, you can see it's still above 80. Even if SPY is just a smidgen below that. And here's TLT reaching that moving average as a resistance level before rolling and really kind of breaking down hard here today. So let's take a look at some of these different asset classes and what they look like here. Here is the dollar index first. Look at that breakout. And that's a big, strong move to the upside. The highest close that we've had outside of September the 3rd, where we got that kind of shooting star candlestick pattern, breaking out of a bunch of highs here, highs and closes. You can see the posture is still strongly bullish. The green line still there. You take a look at the weekly chart of the dollar. And you can see, for some reason, we don't see the moving average in there, but it's rising, and you can also see too that we have the dark green line showing up there as well. Let's see why we don't have that that moving average there. That's a little strange. Usually we should see that. Anyway, let's go back to the daily chart here. There we go. And then go back to the dollar index. So you can see nice, good bullish trend. I mean, if you can see on the crossover chart on this chart here, that we do have a nice, good, strong bullish pattern still. The golden crossover that we had in the middle of 2018 still holding as we continue to trend up and break through this Fibonacci retracement zone all the way up now to the upside. Again, taking a look at TNX, and that's the thing that needs to kind of roll up too. Keep in mind about TNX is, look how significantly bearish this is. You still got such a wide gap here. You've kind of got to break through that gap before you start filling in. And we almost did there a couple weeks ago, but we've had a little bit of a pullback. I wouldn't, as long as there are rate cut odds still out there. And they're still out there. I mean, it's still a 50-50 proposition for October at the next meeting, but it's 53% for a cut. But by December, the odds are much higher. You have over 70% chance. So it's not baked in the cake that we'll get one by the end of the year, but you still have an over 70% chance. Of course, by April, here's where we're at, 12. We're not looking for a rate hike anytime soon. We actually have only about an 88% chance that we'll get one rate cut by then. So, I mean, it's really like this last cut's not really baked in the cake. But even going as far out, 46% for a second rate cut, that means, there's a 50-some-odd% chance that we wouldn't even get a second rate cut. So, there's still, the odds of getting a one cut by the end of the year are not set in stone, but it's looking more and more, according to the markets, that if we do get one more cut, that's pretty much going to be it. It's going to be hard to maintain. So as long as there are odds for at least one more cut out there, then the rates will still remain subdued, at least according to past precedent when we've seen these past mid-cycle adjustments. Once the futures market looks like that we're pretty much done with the cuts, then you'll see rates take off. That's what happened in the mid-90s, what happened again in 98, for 96, as well as late 98. Those yields took off like a rocket. And again, this is a very similar environment from a yield spread perspective between U.S. Treasuries and German Treasuries, which are such a big spread. We have such a, that's similar environment to what we had in the late 90s, and that's really bullish for the US dollar. As you can see here on this chart, that's really bullish for this, and we would expect that would continue to push this all the way up to the upside through 100 and beyond. And that doesn't necessarily mean that we're bearish for stocks, but what it does mean is we'll probably put pressure on stocks like in the energy sector, material sector, and allow your FANG type stocks, technology, communication services, discretionary, your cyclical areas do much better. All right, if we take a look at the sectors and how they're performing, you can see here that there's the biggest winners today were your cyclical areas. Again, very typical when you are in a dollar environment. And also, if we are going to be bullish going forward from here, this intermediate rally is going to take hold, then what's led the initial surge here was gains in financials, industrials, healthcare, energy. Those are your biggest winners. That for us to really get going and maintain a persistent intermediate trend, they can't continue to lead. Right? They can still go up. As you can see, they're both up. But these are the areas you would expect to lead. They're the higher beta names. They're your typical market leadership when you're in a risk-on environment. And you can see that they've taken hold, and some of these other risk-off or safe haven sectors have underperformed. If you take a look, at what that looks like here on the 12 grid chart, you can see. Give me 1 second here. All right, so you can see the cyclical areas up here at the top, and again, there's a lot of light pink shading here, which means we have falling intermediate lines, but it's above 50. We only have one dark green, and that's still the utility sector, and it's still holding up really well. Real estate's already started to pull back. You would expect that real utilities would also start to pull back here to the upside. Now, can they continue to run higher while stocks go up? Sure, they definitely can. Expect them more to show. You can see either small gains or small losses. They're staples to the other safe haven areas. Above its moving average. Healthcare is the only one that's back below a falling moving average, as well as light pink shading. So it doesn't have quite the bearish combination of dark pink shading and a red line. But it does have, it is weaker than all the rest of these that have. And look at all the green lines that we have, which means we're above rising moving averages. So as soon as the intermediate line turns up, this light pink shading will turn that quickly to dark pink shading. And these are the ones that we want up here at the top to lead that way higher. Right now, if you take a look, you have financials, industrials, materials, energy. These are all the ones that have the highest intermediate values. Healthcare. These are the areas, and these are the areas here at the top that we want to eventually have the stronger intermediate values. And one day doesn't a trend make, but this is a good start because this is the first day that we've had this kind of pattern so far. All right, now let's dive into our trade idea of the day. We can take a look here at Nike. Nike is a stock that kind of broke out a little bit on this earnings announcement overnight. You can see the nice good breakout up above $90. Nice gap here. This is what it looks like on an intraday chart right here. Here we go. You can see that we broke out. We started to fill in the gap a little bit, right? So we opened up here, and you can see. So that, which means that we've got more potential to fill in some more of this gap all the way down, maybe into 88, 89, maybe even all the way down to this 87 3/4 level where the point of control is. So there's opportunity for it to keep pulling back despite the breakout. But the nice thing about the breakout, it was pretty bullish. You can see here we got up above the upper band for the first time in a while. We've been kind of threatening with the moving average. We broke out of the value area to the upside, all 52-week highs. You look at the DMI. Here we go in the DMI index here. You can see that we were already pretty bullish as it was, but now the negative index is easily below 20, so that the ADX is going to have an opportunity to really take off here to the upside. You get a surge move that usually leads with a bullish move to the upside afterwards. So we're going to keep our eyes on that to see, if we maintain this bullishness. But first, there's the expectation, and well, excuse me, one more item here on the long-term crossover. You can see, the big bullish move. We've been on this nice, good golden cross since since late 2017. We've had some pullbacks where we've tested the 200-day moving average, and we even got the PPO all the way down here. But still, we've had we're continuing to trend higher to the upside. Regaining these levels that we've had here before, and even after these two pullbacks, back up to new all-time highs. And this is what the chart looks like on a regular candle. We'll see how we hold up, again expecting that we might pull back down into this area in the short term. The nice thing about the options right now, and again, remember, we put this trade on already in the Market Outlook Live. That's a live YouTube video at 3:30 Eastern time. That's the link to it is posted on the Market Outlook page. It's in the top right corner of the screen, top right corner of that blog post. But you can see with two different options here that are between 20 and 50 days essentially, I can come out here and I can say, okay, well, if I were to sell the 90 and buy the 87.5, that's a pretty aggressive. I've got time for this to work out, and I can get a pretty decent reward to risk ratio out of this. For $162, I'm making $88. But I can get closer to that $162 risk with the calendar, by instead of selling the November, selling the October $90 strike price. So this is what it looks like here. So if I were to sell not the November 1st, it'd be the October, and then come down here and buy the 90 here. So there is a calendar spread, a $97 calendar spread. So this is what this looks like. And then come back and analyze this one as well. So the first trade in this is a calendar spread here at, let's get rid of what we've already put on. A calendar spread that's got, for $97, that's got potential reward of over $100. Or essentially adding on a whole $1 worth of credit, up to $1 worth of credit, in addition to the 88 cents, 89 cents that's already in that long vertical spread back there. So the question is, how much am I going to add? Well, that depends on how much this purple line goes up and what we end up getting out of it. But the point is, if we were to continue to pull back into this area and then bounce back up here within the next 20 days, because it's only got 20 days left, which is less than 3 weeks. By the next 3 weeks here, as it pulls back, if it pulls back and bounces up, then we've got the opportunity to add some extra reward. If it goes up right now without pulling back, then we'll lose a little bit on this. The nice thing is that that will make this a higher probability vertical spread by the time that happens. And you remember too that for a $2.50 wide spread, all we need is 58 cents to get a 30% return on risk. So I've essentially got 30 cents or $30 of loss that I can work with on this calendar back to the upside. Before it turns into a trade that would be the typical setup as it is. So you can kind of get an idea now, because of the extra credit, it buys me the flexibility, and because we got options that are 20 and 50 days out, it buys me the flexibility to say, okay, well, we broke out. We'll probably do a little bit of a pullback into this gap, continuing into this gap. So if that happens, then I'll get a little bit of a gain on this calendar spread that and anything I get gets added to that credit in the spread here in November, and then I can just let that trade go just like normal, just like any other bull put spread on a stock that's broken out, that's on a bullish trend, that's already had a pullback and retest, if that occurs, and back to the upside. So it's essentially a way to do a bullish trade in the stock that's breaking out, but without necessarily chasing it, right? Because if we do pull back, which is bound to happen when you're chasing something, then in that case will actually make us money with this calendar spread. And then if it holds that that breakout and turns right back up to the upside, we get rid of the calendar and we just stick with that high probability with now more reward because of whatever I make on the calendar gets added to it. All right, well, that wraps us up for today. As always, I appreciate you coming on. You've heard from me now. Now I want to hear from you. Use that link right there to take you to our Market Outlook forums. You have to be a subscriber to our site for free to be able to participate in that forum, but I showed you how to do that earlier in the video. Open up any new thread with any questions or comments you have on anything we talked about in today's video, or for that matter, anything we didn't cover but you want my take on. You can post it in there as well. You can also reply to anybody else's thread. It's meant to be a community, right? A conversation. So let's keep that conversation going. As always, remember to subscribe to our YouTube channel, hit that thumbs up icon down below, and then comment on the video. Follow me on Twitter for more content in between the videos from day to day. And like I said before, subscribe to our site with that subscribe button I showed you earlier. As always, thank you very, very much for coming on. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.